What if I told you that by understanding the logic of smart money, you could have known exactly what would happen to Bitcoin over the last 6 months? You might think that's impossible. The market is chaotic. There are too many factors, but that's exactly what separates the crowd from those who understand how prices actually move. I want to show you the logic behind price behavior and how to apply the smart money concept to trade crypto profitably. After watching this video, you will understand why the price has reached this point and how to use this knowledge to make money. Now, let's figure out why the cryptocurrency market has been moving this way for the past 6 months. To do this, I'll open the daily Bitcoin chart dated December 18th, 2024. It was at this moment that a series of movements began that seemed chaotic to many. But if you understand the logic of smart money, you will see that everything happened according to a completely predictable scenario. Remember the main thing. To analyze the market, we need only two things: an understanding of liquidity and areas of interest. It's time to move on to the logic of price behavior. We have the daily Bitcoin chart in front of us, and the first thing to pay attention to is the direction of the trend. I always start my analysis with this, and exclusively on the higher time frame. In this case, the trend is clearly upward, which means that the main priority will be to buy. This is important to understand. When you trade with the trend, you can set your goals further. The momentum is working in your favor. On the other hand, trades against the trend often result in only short pullbacks, and the risk of making a mistake is much higher. For this reason, at the very beginning of the analysis, it is important to determine where the algorithm is currently working. Now I mark the liquidity zones that are relevant to me at the moment. The first zone is obvious. It's the current maximum. There are almost always stops behind such a maximum. Think about it. If you decided to go short, where would you place your stop? Above the maximum. That is why this area becomes a liquidity zone where there will be interest in selling. The second zone is the compression area slightly below. Please note, there were several consecutive corrective movements here. For traders entering these corrections, it's logical to place stops below local lows. And for those who understand the logic of smart money, this is compression with a dense accumulation of liquidity. I also mark unfilled areas on the chart after sharp movements, the so-called imbalances. These zones are formed by momentum, without price reversal, and often become the very areas to which the market returns. These are the zones of interest for a possible entry. So, we already have a structure, a trend, liquidity zones, and potential areas for reaction. Next, we'll see how the price moves through these zones, and you'll see for yourself that everything is quite logical if you know where to look. We continue to monitor the price. Relatively equal lows appear on the chart. Remember, equal lows and highs almost always become the most obvious target for liquidity withdrawal. The logic is simple. There are stops there, so that's where the price will go. Next, the market does exactly what we expect. First, it removes the sell side from these equal lows, then clears the local buy side on the pullback, returns to the short fair value gap zone, and gives a clear reaction from it. After touching the edge of the fair value gap, the price turns down and goes to remove the liquidity that we marked at the very beginning of the analysis. Let me explain right away. I had no trades in this area. This is local work within the range. I deliberately trade such areas rarely. Here, it's not the entry itself that is important, but understanding the logic of the movement. Equal lows acted as a magnet for liquidity withdrawal. The return to the short fair value gap provided a reaction point, and then the algorithm continued to deliver to the lower pools. The short fair value gap is not the end, but only the beginning of the scenario, after which the market consistently follows the next liquidity. After the sell-side liquidity is withdrawn, a window for purchases appears. All the lower pools that we noted have already been taken, so the next logical task is to deliver the price to the buy-side liquidity above the highs. To find the entry point, I switch to a lower time frame. 15 minutes or 30 minutes will be fine. It's important for me to see that immediately after the liquidity was withdrawn, momentum appeared, and a fair value gap formed. I mark this area on the chart. The plan is simple. Wait for the price to pull back into the fair value gap and open a buy trade from the zone of interest. I set the stop at the minimum sweep below the lower boundary of the fair value gap. The target is liquidity above the current maximum. According to my calculations, the risk-reward ratio is about 1:6. This trade closed only a week later. In crypto, I tend to hold positions longer than on indices or forex, but the logic remains the same. First, liquidity withdrawal, then confirmation on a lower time frame through fair value gap, and only then entry. Now, the most interesting part begins. How the market transitions from complete euphoria to fear and the desire to sell. A new high has appeared. The crowd is waiting for Bitcoin to go higher and higher, a classic state of euphoria. But if you look through the eyes of the big players, it's no longer profitable to buy here. Their task is to shift expectations, force retail participants to sell, make the asset cheaper for subsequent purchases, and at the same time bring the price to the previously marked imbalance zones. At the beginning of the video, we highlighted two fair value gaps below. They need to be filled. If you don't understand this logic, the decline will seem like a normal pullback. I want you to see how this works in practice. The price begins to fall and arrives exactly at those two fair value gaps. The first pullback appears from the imbalance zone. The reaction is expected. Some sellers lock in their profits. Some try to catch the bottom, but this is only an intermediate pause in the delivery scenario. I switch to the hourly time frame. Here we see a new fair value gap and three local liquidity zones. The scenario repeats itself according to the pattern. The price removes each of these liquidity zones in turn, returns to the edge of the fair value gap, works out the reaction, and then goes down again to remove sell-side liquidity once more and arrive at the next fair value gap. As soon as the price removes the next liquidity and returns to the fair value gap zone, a pullback begins. And what is significant is that the pullback goes exactly to the short fair value gap. This is logical within the scenario. First, the stops were taken from below, then an intermediate delivery was made up to the supply area, from where a reaction was received, and the movement continued downwards, straight to the lowest fair value gap. It is from this lower fair value gap that I'm considering a new buy trade. This is the perfect moment from a logical point of view. All the imbalances marked at the beginning have been filled along the way. Sell-side liquidity has been withdrawn in stages, each time giving a pullback and catching up with stops again. On the lower time frame, it is important for me to see confirmation, a change in structure, and the appearance of a local fair value gap after a reaction from the zone. Entry: on a pullback back to this local fair value gap, stop below the minimum of the sweep, below the edge of the imbalance zone. Target: buy-side liquidity at the top. In other words, the maximum that formed above. This target setting is justified. The market has cleared the lower pools, balanced the movement through the fair value gap, and now has a meaningful task to deliver the price to liquidity at the top. So, as you can see, this movement is not chaotic at all, but logical if you look at it as price delivery. Everything went step by step. Liquidity withdrawal, returns to pre-marked areas of imbalance, reaction from short and long zones, filling the fair value gap, and only then the next step. Each stage had a specific algorithmic task. First, to take out the stops where they were most numerous, then to deliver the price to the zone of interest from where it was profitable to continue the route. The main thing is to clearly understand why the movement started and where the algorithm is taking the price next. When you see the sequence liquidity, fair value gap, reaction, delivery to the next liquidity, the market stops looking random, and the trading plan becomes clear and reproducible. I usually trade crypto on Euphoria. It's a decentralized exchange where you have complete control over your funds, no intermediaries, and no account freezes. KYC is not required. Just connect your wallet, MetaMask, Trust Wallet, or any other, and start trading. The terms are convenient. Lower commissions, an interface at the level of top CX, and leverage of up to 100x for those who consciously work with risk. Fast, convenient, anonymous. Everything you need for active trading. I'll leave a link to Euphoria in the description. Now, when the logic of smart money has become clearer, let's open the current chart and see what is happening with Bitcoin right now. The picture is familiar. After the removal of sell-side liquidity, the price reacted from the fair value gap marked above, then removed the maximum of the previous wave and returned to the lower fair value gap. A short fair value gap has formed here, from which a pullback is logical to expect. If this pullback continues, the next reference point is the lower fair value gap. From there, I will watch for a reaction and look for buys in case of confirmation on the lower time frame. I analyze Bitcoin to make it clear what to look for, where to expect the price, and most importantly, why it came to this particular zone and what triggered the subsequent movement. You will see the same logic on any asset. Open the chart of any coin and follow the sequence of liquidity withdrawal, returns to the fair value gap, and reactions. This is the behavior of the algorithm, not a coincidence. If you are not yet entirely clear on how to apply this in real trading, you can start with something simpler: the owl indicator. It is not related to liquidity or smart money. This is a different approach, working with the trend with clear risk. The indicator shows the entry zone, the place for the stop, and the targets, without manual marking. I recently opened a trade on Ethereum. It brought in about $11,000. A dedicated video with an analysis and the entire chronology of the trade is already on the channel. Watch it to see how an idea turns into a result step by step. The link to the indicator will be in the description. As you can see, understanding the logic of smart money gives you the main thing, the answer to two questions: why the price came here, and where it has an advantage to go next. This removes the chaos from the chart and turns it into a sequence of understandable steps. I hope I have managed to convey the basic logic that it will really help you in your trading. If you found the video useful, please like it and subscribe. Write in the comments what remains unclear or what you would like to see in the next video.